This isn't a normal pullback. This is a macro shift driven by oil, war, and rates. But historically, these movements actually lead to some of the best buying opportunities. Year to date, I feel the S&P 500 is down about 5.56%, QQ is down 6.41%, and SCHD is still holding strong, up 10.5%. And today, I'm going to give you the most important news from the past week or so. I'll also cover information on a couple of rebalances that happened in major ETFs. Updates regarding the Fed rate and very important earnings report data coming out in May. Each week, I'll also give you a few companies to watch and explain why they matter for what might happen in the overall stock market. This is a big one. Let's get into it. We're all feeling it in the stock market right now because stocks have logged multiple weeks of declines. The market has fallen for 4 consecutive weeks, and recent sessions have been extremely volatile. Big up days followed by sharp sell-offs. The Nasdaq has even flirted with correction territory. Right now, confidence is shaky and volatility remains elevated, but this also creates long-term opportunities for investors. Most of this is being driven by one specific sector, technology. Tech stocks, specifically the Magnificent Seven, are slumping hard. Overall, they're down about 12-13% this year, with some falling even more. Microsoft has taken a big hit, and Meta has been dropping rapidly, with no clear end in sight. The Nasdaq has been hit the hardest due to this tech weakness, and investors have been rotating out of AI-driven hype and into defensive sectors pruning, which explains why SCHD is performing so well. We've all been seeing this. Anyone who has been investing for a while knows it hasn't been very fun lately, but hopefully you're staying put for paneling. And if you have some cash on the sidelines, you may have started putting some into the areas that are hurting the most. Now let's talk about 2 major ETFs that rebalanced this week for years. The first one is SCHD. SCHD removed some big names like Cisco, AbbVie, and Valero. In their place, they added United Health, Abbott Laboratories, Procter & Gamble, Qualcomm, Accenture, Comcast, ADP, and Blackstone. I really like a lot of these additions. Overall, they reduced their energy exposure, which had become overweight last year, and increased financials. This reinforces what SCHD is all about: staying defensive, maintaining strength, keeping technology exposure low, and continuing to offer a solid, growing dividend. The share price has been performing well because of this strategy. The second ETF that rebalanced is SPMO. Their rebalance was even more dramatic. The previous version included Meta, but the new version has completely removed it. They added positions in Micron, Johnson & Johnson, and increased exposure to Google, which is now one of the largest holdings. There's also exposure to Caterpillar and AMD. For those who haven't seen my full video on SPMO, it's one of my favorite and most exciting ETFs because of its strong momentum tilt. It focuses on investing in what's performing best at the time and what's likely to continue performing well prams, constantly adjusting to follow the trend. Historically, it has outperformed the S&P 500 while also experiencing smaller drawdowns. For example, when the S&P 500 dropped about 18% in 2022, SPMO only fell around 10%, and during market rallies, it tends to outperform significantly. Now let's get into the biggest news from the past week. Nothing is bigger right now than the Iran war escalation, rising oil prices, and the broader energy crisis. This situation is not just ongoing, but it's intensifying. We're seeing missile strikes and increased involvement from Gulf states. Iran is restricting the Strait of Hormuz and charging ships millions to pass through. Oil prices have surged above $100, and some analysts warn that $150 oil could trigger recession-level damage. This is currently the biggest driver of the market. Investors are pulling out of riskier assets, and in many cases, it's moving into cash while they wait for more clarity. If this situation continues, it could absolutely lead to a recession. Even if it doesn't, it's already fueling inflation concerns, which is now the #1 macro variable investors are watching. Rising oil leads to higher inflation expectations, which complicates Federal Reserve policy. Economists warn that sustained high oil prices could significantly slow economic growth. Now let's talk about the Fed. The Federal Reserve recently held rates steady, signaling uncertainty. Rising oil prices were not part of their original forecast, making policy decisions even more difficult. Globally, central banks are split. Some are still raising rates due to inflation. What we're likely to see now is delayed rate cuts, which in the short term could continue to pressure the stock market. And combine that with rising oil prices, economic uncertainty, and reduced consumer spending, and it points to continued short-term pain in the market. Recession concerns are also beginning to rise. Analysts suggest that oil prices between $120 and $130 could push the U.S. toward a recession. While some forecasts still show economic growth, consumer spending is weakening beneath the surface fringe, particularly among lower-income consumers. We're seeing rising credit stress in areas like auto loans and credit cards. This isn't an immediate crash scenario, Fuff. It's more of a slow bleed, where negative factors build over time until the market suddenly finds itself down 15 to 20%. Firmly in bear market territory. Now let's look ahead to something very important, earnings season. Q1 earnings begin in May. Expectations are still relatively optimistic, but companies are now facing higher oil costs, slower consumer demand, and prolonged high interest rates. Personally, I don't expect Q1 earnings to be severely impacted yet. However, the following quarter could be much more challenging. If earnings are weak this April, the market could be in for a rude awakening. Here are the key companies to watch. Week 1 to 10th, consumer spending. Nike swing, a weak report could signal slowing economic activity. Week 2 ping, financial sector signals. Goldman Sachs and Bank of America thing, critical for recession indicators. Week 3 tashira, consumer behavior. Procter & Gamble, Netflix, Verizon trigging. These show whether consumers are cutting back. Week 4 Hanger, big tech. Tesla, Apple, Microsoft, Amazon, Clee, these will heavily influence the direction of the S&P 500. Overall, these 4 weeks of earnings in April are extremely important. Now, I want to be completely honest with you. These videos are about giving you the most important news from the past week and helping you understand what it means and what I'm personally doing about it. But there are things even more important than just following the news, especially for your personal financial future. If you feel like you already have your investing strategy figured out and all you wanted was a weekly breakdown of the market, that's exactly what this video is for. But if you're at a point where you truly want to change your financial future and get serious about investing, and this next part is for you. Right now, in 2026, with the market down, this is one of the best times to get organized and build a strategy and start entering positions that could change your life. I see this all the time, Everett. People become paralyzed during downturns, constantly tweaking their portfolios and chasing random advice. But the moment they build a structured system, everything changes. That's why I created the Ultimate ETF Wealth System. After seeing the success of our first cohort, I've opened cohort 2. This is an 8-week live program starting April 1st with live calls every Wednesday evening. Every session is recorded, so you'll never miss anything. Inside the program, you'll get 8 weekly live calls with direct Q&A, templates and calculators you can use immediately, access to an exclusive community, full recordings of every session, group accountability, and direct feedback on your portfolio NM. We also have an active group chat where members support each other throughout the process. The program is divided into 3 phases. Phase 1, build your personal investment policy. Phase 2, optimize accounts, design allocations, and automate your strategy. Phase 3, stress test your portfolio, and finalize a long-term plan hive. By the end, you'll know exactly what to do in bull markets, bear markets, and corrections. We're limiting this cohort to just 50 people to ensure everyone gets personal attention. The first cohort filled quickly, and this one likely will too. Once it's full, the next opportunity won't be for several months, Tanny. And by then, the market could look very different.